Welcome to Satya Skills. In this video, let us learn something about second phase of banking sector reforms. We already learned in general about banking sector reforms already in other video. Now, to review the progress of reforms, the Government of India constituted a committee on banking sector reforms under the chairmanship of Mr. Narasimhan in 1998. The committee was entrusted to review the progress of ongoing banking sector reforms. The committee submitted its report with a series of observations and recommendations in April 1998. Some of the recommendations were: strong banking system. The committee felt the need for a strong banking system for India. This recommendation was made in the context of capital account convertibility. It requires inflow and outflow of capital on a large scale. To facilitate a smooth flow of capital, strong banks are essential. The committee recommended that some banks can be merged to form a big and strong bank which can be given international banking status, and such banks are capable to handle national and international banking operations conveniently. They can compete with banks at global level. Such banks can influence the total banking industry of a country with a multiplier effect. Second requirement or recommendation, the committee observed that there are financially weak banks in the public sector. Thus, they recommended narrow banking to them. Now, let us see what is this narrow banking. Such weak banks are suffering from losses and high percentage of non-performing assets. These banks are to be reorganized and placed on the regular track of banking business. To rehabilitate such weak banks, the committee suggested the concept of narrow banking. It implies that a weak bank should be encouraged to divert their limited funds towards less risk assets and should be encouraged to invest in short-term risk-free assets. Narrow banking reduces the level of non-performing assets gradually and brings back the sick bank into a healthy position. Another recommendation, small local banks. The committee suggested a model structure for Indian banking. It consists of 2 to 3 large size banks which can be at par with the international banks and should be able to offer such banking which is of global in quality standards. They should be given international status. There can be 8 to 10 large banks which can take the role of national banks. They should be able to cater to the needs of large and medium enterprises in the corporate sector. Such banks should be able to provide the services at national level to the required sectors. The committee suggested that there should be large number of small local banks to provide banking and financial services to local needs. Such banks should confine their services to the particular state or a group of districts in a state. They should serve the needs of domestic and local trade, local industry, small industry, agriculture, allied activities, cottage and tiny industries, etc. They should concentrate on deposit mobilization of that area and divert to the investment channels which contribute to the progress of that area. The committee also recommended that these small banks should have a strong correspondence relationship with large banks. This is like a correspondent banking system or unit banking system that you already learned in some of the previous videos. This facilitates small banks with national and international banking and finance activities. Another recommendation, capital adequacy ratio. By March 1996, all the banks in India achieved 8% of capital adequacy norms set by the RBI in 1991. By March 93, all foreign banks achieved the target. The committee in its report recommended that capital adequacy ratio should be improved further. This will be a great support to develop strong banking system. Adequate capital strengthens the banks at a base level that can influence the quality of banking significantly. Enhanced capital adequacy ratio improves the risk absorbing capacity of banks. Thus, In the conditions of uncertainty, banks can encounter challenges of different types of risk. The committee suggested to constitute asset reconstruction fund to take over bad debts of the banks. Another recommendation, autonomy to Board of Financial Supervision. About Board of Financial Supervision, you already learned in one of the previous videos. The committee suggested to give real autonomy to BFS. The board as a policy maker can formulate procedures and norms of disclosure. The board should not interfere in day-to-day affairs of the management of the banks. The board can supervise through efficient system of mechanism and procedures. Another recommendation, this is another very important one, updating banking law. You know that our banking law is English law, based on English banking law. The committee suggested reviewing the provisions of different acts that govern the policy and procedures, operation and working of banks and financial institutions. The important banking laws at present are RBI Act 1934, Banking Regulations Act 1949, need to be reviewed in accordance with the changing banking requirements. This facilitates Indian banks to reach the global standards according to global demands. Then mechanization, computerization. The committee suggested for computerization of all the branches of public sector banks. The committee also recommended to review the recruitment procedure, training, payment policies of banks towards employees. It is necessary to give priority to human resource development program to make banks more competitive. These are the few recommendations of the second phase of reforms by the committee. That's all.